We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Greg Weldon, publisher of the Global Macro Strategy Report, 42-year financial market vet, and commodity trading advisor. Greg, thanks for joining me today. How are you?
My pleasure, man. How are you?
Excellent. It's great to have you back, Greg. And, I always look forward to chatting with you, on and off record here. But you recently highlighted what Scott Bessent said and really translated it. His statement was that the U.S. will never default as Congress faces endgame. So what is your translation of what that means?
Yeah, well, he's talking, of course, about the debt ceiling and the whole 9 yards around the big, beautiful bill and the expansion of the deficit. And, Rand Paul and some of the politicians saying, we have too much debt and we can't default on our debt and we just got downgraded and so on and so forth. Well, bottom line, what he's saying is, okay, if he is guaranteeing we will never default, he is telling you we will always devalue the currency in perpetuity, because that's the only way to make sure we don't default. And this is the case where I have called it, one of my themes for 2025. I always do a year ahead piece and pick 5 or 6, major themes I think we'll see in the year. One of this year's was crossing the macro event horizon, which is a reference to a black hole. Okay, so if you know physics, once you enter a black hole, you are trapped in the gravitational pull of the hole. But before that gravitational pull is strong enough to rip you to shreds, you're actually still traveling and you don't know you've been captivated by the black hole yet, but you can't get out. You don't have enough energy to burn as propulsion to get yourself away from that gravitational pull. Well, I would suggest, and I have charts on this. I just did a big special on the U.S. bond market. I'd be happy to send out. But one of the really cool charts is it's pretty simple. It's not rocket science. When you put the numbers together, you put the charts together, and you put the string of history together over the last 40 years, it's pretty clear. All right. What you have is debt that was trailing GDP growth for decades. And what changed everything was 2008 when they started printing money. QE, helicopter money, helicopter bend. What happens? So these things are moving kind of, together. And all of a sudden, the debt comes up and meets GDP. And now we're running about the same on, sovereign debt versus annual GDP. So it's about 100%. You measure this in percent of GDP, every country. So when you look at what happened in the pandemic, and then you throw in, not only do we have 36 trillion in public debt, we also have 18 trillion in household debt. That is, 54 trillion, and it's all the same. It's our debt. Public debt meaning we the people, household debt meaning we the people, and then the government goes and prints bonds, sells those bonds, and uses those dollars, right? They print the bonds, and they sell the bonds back to who? We the people. We own 80% of these bonds. So it's kind of crazy how this whole thing is even working. But the most important fact is when you take all of the household debt and public debt, you're at 54 trillion relative to GDP. That's 186%. What does that mean? Well, it means now the debt is way higher than GDP. You're in the black hole because you need to print $1. You need to create $1.86 of new credit or debt to generate a new dollar of GDP growth. You need the growth to service the debt, or you have a debt deflation. Every central banker on the planet that's ever existed on the planet will choose to reflate and experience the debt deflation. There is ample evidence of this throughout history, and the biggest way you do that is perma debasement of the currency, and we're seeing that now. And if you look at gold, tells you that. I like to look at what I call the gold adjusted value of the dollar, because I've also done studies on what was the average car price in 1973? What was the average apartment price? And you see inflation in everything, right? I mean, because that's the debasement of the dollar. Mm-hmm. So when you look at it in gold terms, you just took out 3 cents on the 1973 dollar in terms of the dollar's purchasing power for the first time. And that's a record low. And you made a record low a few months back. You took out the 2011 low because finally now the dollar's also breaking as gold's going up. Gold started going up because other central banks are buying it, but now it's going up because you're looking at a debasement of the dollar.
Mm-hmm. Do you think this statement needed to be said, Greg, because of the Moody's downgraded to the U.S. credit rating?
Well, yeah, I mean, yes, but other credit agencies had already downgraded the U.S. So, it's kind of like Moody's was the last to go, and now everyone has. And what's interesting about it, too, is if you look at the scales, I mean, it's almost like, Germany is the place to be now. And now you start to, this plays right into this whole thing. Okay. So if you take those credit rating agencies, and Germany's now the AAA, Germany's now the safer bond, theoretically, right? If you look at it that way, even though they have their own problems, and they're going to expand their fiscal thing. But, they're one of the few countries that actually got below 60% of debt to GDP in its most recent pre-pandemic period, which was even, worse than, better than, I should say, the ERM rules, where 60% was where you would start getting penalized. Of course, they've never penalized anybody. And now Italy's like at 180, as well as the US at 180. But the point here really being that when you're talking about those credit rating agencies, all of a sudden we had a strong dollar because US rates have been high relative to all these other countries' rates. The Fed has been a little more stingy with the rate cuts versus Europe. You've seen the interest rate premium expand. So when you're getting more interest rate premium, you're holding dollars, and a lot of that currency moves, pretty quickly based on interest rate differentials. Well, now you ask yourself, is, 100 or even 200 basis points relative to the Bund pay for the risk to the dollar and the bond market? You're getting 5% there, you're getting 3% in Germany, but the dollar's going down, and the Deutschmark, listen to me, the euro is, that shows you my age. The euro actually looks good for the first time in my mind in like 20 years, right? And in this case, there's a reason for that, and that is, money now maybe would rather be in Europe than the U.S. Certainly, our trade situation doesn't help, and the fact that Trump has pushed away a lot of our allies and further pushed away our enemies on all of this, and given all these countries that want the BRICS unit, all the more reason to be all the more urgent about creating it. I think that speaks volumes to the entire problem, let alone the problem we have in the bond market.
But doesn't Europe have a lot of the same, realistically, the same debt issues without the potential for growth?
Potentially, yes. I mean, that's the argument, and that's a valid argument. So yes, and that's kind of why I like gold over all these. I mean, you talk about which currency, and like I said, the euro looks the best it's looked in 20 years. It doesn't mean I want to own it necessarily. So
Yeah.
It's kind of a relative game there. I would say there's almost two ways to answer this, but part of this issue is, though, too, that we have all this refinancing to do. When you look at the numbers, you get back to the bond market, the piece I just did, and the map. 9.3 trillion in debt maturing in the next 12 months, right? For the fiscal year, all right, 1.9 trillion in public borrowing requirements. They only did like 20% of that in the first 7 months. So for the next 5 months, we got 1.4 trillion in new debt, let alone any new spending that comes up because of this bill. So you're looking at it, well over 10 trillion in debt that has to be sold in the next 12 months. At a time when people are moving away from buying U.S. assets. That's the problem right there. So that's why all of a sudden Germany does become a place that seems safer, not necessarily for the next 10 years, but for the next 12 to 24 months in potentially a big way. The flip side of that, too, is, of course, gold. And I just did a piece not too long ago where I said, is Bitcoin the new T-bond and gold the new dollar? Right? Because if you look, all of a sudden I noticed this, and then I ran a bunch of runs on this. I mean, when the 30-year Treasury T-bond gets above 5%, that's when Bitcoin's been above $100,000. The correlation is pretty tight. The directional correlation is quite tight, and Bitcoin is outperforming the 30-year T-bond price in a secular bull market and just made new highs. So I think that that's really interesting to me. And now you're talking about banks being able to crypto and being able to pay a yield on crypto. Holy mackerel. I mean, that just opens a whole nother can of worms in terms of competition for the bond market at the time when you don't need more competition for the bond market. And what does that mean? At the end of the day, it gets back to Bessent, okay? Because what it means is the Fed will turn buyer of T-bonds when they have to, will print more money and give it to them so they can do it, because we guarantee we won't default.
So, Greg, as just to kind of understand a little bit more about that, the debt situation, what is the appetite from foreigners for U.S. debt? Do you see this also as maybe a factor in the downgrade?
Big time. And that's what I'm talking about right here, too. When you have all this debt to sell and you have buyers, kind of disappearing to whatever degree, and the Fed, again, the buyer last resort will be called in to carry the weight. When you start to talk about something like the BRICS unit, when you talk about China, actually, the UK just moved above China. I mean, China is continuing to sell bonds. Why? Because they sell the bonds, they take the dollar proceeds and buy gold. So this is back in the BRICS unit. And, it's kind of lost it in the public sense of acknowledgement and awareness in terms of the BRICS unit. But if you don't think that what Donald Trump has done the last few months hasn't pushed those countries to want to make this happen even more, then you'd be kidding yourself, because they just took a whole bunch of other Russian banks off the SWIFT system. I mean, this is, asset war, financial war, resource war, commodity war, and the degree to which the bond market and the dollar are in harm's way in this sense. They have the better firepower than we do now. So Japan even, and you worry about Japan maybe, turning tail and selling U.S. bonds. There's some thought process that Japan wants to see some repatriation of capital to Japan, and the yen would be strong, and that would be negative for the dollar. But again, right now, they're the largest holder of U.S. Treasury securities out there among foreigners. But foreigners still hold such a small percentage. They hold about the same amount, frankly, as do U.S. commercial banks in total. All right. So U.S. commercial banks are sitting on huge potential paper losses. Not they're going to sell those bonds. Of course, they'll hold them to maturity and realize no loss. But does it make their appetite for new bonds a little bit less going forward? I think it does, let alone the public. You talk about public where, savings just rose only because transfers from the government to the public was the biggest portion of the income gain we just saw. Right. So, I mean, these numbers are so polluted. Everywhere you look, you kind of see problems, and a lot of them turn back on the bond market because, again, public ownership of public debt is over 80% of the 36 trillion. So that means that we continue to need to be buyers. Well, after this last experience of 60-40 and what happened to portfolios, you think people are going to be rushing into bond funds? I don't really think so.
Greg, you mentioned the idea of Japan repatriating some of their assets. Is that symptomatic of this, major new high in Japanese bonds, Japanese bond yields?
To some degree, yes. They have their own issues, and when you start to see where the 40-year bond went, and let's be real. I mean, Japan has a 3.5% inflation rate against a 0.5. It's actually 3.6 against a 0.5 policy rate. I mean, they're stimulative with a real policy rate of minus 300 basis points. I mean, wow. And they're still buying assets, even though actually they're not. It just rolled over. It just peaked. It's down a little bit, but barely at all. And the most recent week, it started going up again. Mm-hmm. So it didn't take them long. And this gets back to another point, too. It brings up kind of a side point that I think gets to that question. Because what you kind of see is as this is happening, you get these yields where it gets to the point where people are now afraid of the market to some extent. And again, like they kind of drive as buyers and then they leave. And they're back now in Japan where they don't need as high a yield as they're getting in the US because the currency conversion alone could be a factor. And the other thing you might say too is the Japanese selling bonds and taking the dollars and they're not converting them to yen. Maybe they're buying gold. I mean, so there's so many angles on this one that I think that this could apply to a lot of countries, and you could look at countries like Brazil, which really, doesn't hold a lot of bonds, but they hold enough. And if they turn seller and other countries are turning seller, and who's the biggest buyer of gold? I think in the first quarter, wasn't it Central Bank of Poland, right? Their currency been one of the strongest. Their economy's been one of the strongest because their central bank was very active in fighting inflation when the Russian war broke out. And now they had so much room to ease that they have really done a great job of stimulating the economy to where it's one of the strongest in the world. The currency is strong, and that's another knock on the dollar. And it's another country that might kind of move off the fold away from the EU. And I think one of the coalitions just broke down today in Eastern Europe too that was pro-European. So, man, again, I know I'm all over the map, but it's just like all the tentacles lead so many different places that this is why I end up working 18 hours a day.
Well, and I mean, it's a great point, and that's why we have to continue having these conversations over and over so many times. is to try to understand where these tentacles are, what the ramifications are of them, and where they're going. And, in that vein, Greg, we think about all of these debt problems. Is a possible solution going back to some sort of let's say, a gold-backed dollar or gold-backed bond? Why or why not?
Well, I don't know. I mean, I kind of cringe and I kind of chuckle a little bit when I hear that, because at the current price of gold, U.S. gold reserves barely cover maybe a year and a half of our deficit. I mean, it's kind of like, what are you going to do? Revalue gold to $50,000 an ounce? Because that's kind of thing I think you'd have to do to have any credibility to that. Unless there's another way to do it that I'm not thinking of, or there's some new, angle on this. I don't know. I mean, shy of also going out and basically confiscating people's gold and silver and making silver tier 1 and doing all those kinds of things. I think I don't want to use the word folly, because it's a good idea. The problem is 1990 was the last time you could have realistically done it, in my mind. I think it's just too blown out right now in terms of debt and the amount of gold. And if you want to reprice it just to cover household and public debt, I mean, I'd have to do the math on that. But my guess, just off the top of my head, would be you'd be looking at somewhere around $120,000 an ounce gold. They're gonna go for that? I don't know how that works, because then the loaf of bread costs $200. But that's where we're going. It's just that we're going to do that piecemeal. So stocks will go up because stocks in a lower dollar is one of the greatest correlations. Now you're seeing rotation in the stock market away from the Mag 7 into Mag Silver. So you got some of that going on too.
Well, I was going to ask, what does this mean for the rest of the market, Greg? You say that silver could be a excellent beneficiary of this. Of course, yesterday we saw silver up. Of course, we're again recording this on Tuesday, June 3rd. So what does this, this excellent day, 5.5% up day in silver mean? And is silver starting to gain some traction here?
Yes. Yeah, it is. Now I'm asking, is it 3 for a quarter? I mean, third time's the charm, because October 24, we were here, March of this year, we were here, and we thought the same thing. But it's different here. The backdrop is definitely different. The biggest thing is the dollar has broken down. The dollar has gotten below 99.54, which was on the cash dollar index, which was a key secular level. If you look at the dollar index, it was a bear market going back to when Volcker defeated inflation, 1982-83. Dollar peaked, came down all the way to 2008, had a little bit of a rally, but then 2011 was a double bottom when we had EU debt crisis and the first big U.S. debt ceiling crisis. Okay. Biggest oxymoron ever, debt ceiling. There's no ceiling to this debt. I mean, come on, let's be real. But when you look at that dollar move, okay, and including the Plaza Accord in 1985, which I was in the markets at the time, that was one of the biggest days ever at the time. It was insane to devalue the dollar because the dollar was too strong. The rest of the world growth was flagging, so on and so forth. Again, to try and stimulate overseas consumption to stimulate the world. Now we'll be back on the side where we're trying to stimulate U.S. consumption to stimulate the world by bringing the dollar down. So in the sense that from 2008, 2011, then you had a perfect, mathematically, Elliott wave, Fibonacci, all of this ties into a massive ABC rally that comes into the peak we saw in 2022. Since then, we've violated that entire uptrend from 2011 to 2022. That correction also hit the 50% retracement of the entire decline from 1983 to 2008. It's perfect. It's so tight. It's almost too tight where you'd say, did you draw this to make it look this good? Because that's how good it is. So now the dollar's breaking down. You've hit a 5 to 6% year-over-year rate of depreciation, which is something I watch very closely. The various rates of change. And when you get to 6, and then the next step would be 15, now you're talking about enough dollar depreciation to have an impact on the markets. And I have said repeatedly, maybe even in one of our interviews in the past, people, complain and are frustrated with silver, and justifiably, because it's all this, everything's moving and you want to make your money real fast these days and get paid right away. The problem was, and I said this the whole time, look, silver, given what the dollar was doing, was a remarkable performance and just holding up, first of all. And then the degree to which it would only take a dollar decline because central banks were buying gold. There wasn't a rotation of speculative money into gold or a stock market, Wall Street money into gold. This was central bank buyers of gold because tier one, it backs the BRICS unit. That's why they're not buying silver. Central banks are not buying silver. So this is why silver lagged. This is why the ratio got so out of whack, and everyone's all like, "This can't be." It's like, just all right. It's like, everyone remain calm. All we need is the dollar to crack, and silver will go. The dollar is cracked. Silver went yesterday. We put out the recommendation last week, particularly on the SIL, which is a major breakout to the upside.
So, Greg, when we think about this, let's say this debt picture going forward, what does that mean for the Fed's actions also going forward? They seem to be caught between a rock and a hard place here.
Yeah.
How do you see that picture playing out?
That's another 2025 outlook kind of theme to watch. And we've watched it develop really well. And we just got some new information on this last week that is critical that I've heard very few people talk about. And that is that the Fed would be forced to acquiesce to higher inflation to protect the consumer and to protect growth. Like I said, again, you're peering into a debt abyss and a debt deflation. I mean, understand that the revolving credit and credit card debt has been down 4 and or 5 months in a row on a rolling 12-month basis in terms of dollar growth. The only other times we've seen that were during the pandemic and in 2009 and 10 after the crash in 2008. The only times. Mm-hmm. So we have now a consumer cocoon, which was another theme coming out ahead because the consumer has been hurting for a while. And when you talk about the University of Michigan survey, which some people don't like the University of Michigan, you can take New York Fed survey, you can take a lot of surveys, we can take a lot of these data points. It comes back to one thing. The consumer is as negative as the consumer has been in 45 years. The inflation expectations are completely unanchored. And for the Fed to keep saying that inflation expectations, which they even said in their minutes from last week, are well anchored is a blatant lie. Now, it behooves them to try and get people to believe that lie, of course, because otherwise inflation expectations really are unanchored. Now, they will have to acquiesce to higher inflation to protect growth. And I think that's part of the reason they have been more reluctant to move until they really have to when labor market. One of the things that the meeting minutes said is they expect substantial weakening, quote unquote, those two words, substantial weakening in the labor market in the next 2 years. Okay. And they also there were several paragraphs of discussion about the various, the upper level, the lower level of the Fed funds range. And would it be more effective in implementing policy, especially if, and they didn't say this part, but of course, this is what I think right away when I read this, especially if, we want to cut rates, but inflation is still higher than, our 2% target, would be to go to an inflation targeting range of 1% to 3%. They didn't say 1% to 3%, but I've been saying that for the last 18 months. Mm-hmm. And I kept saying this will take a couple of years to get there. Well, all right, so if I started saying this 18 months, I said it would take 3 years, we might be halfway there already. So I think that that's really interesting because that's as much of a acquiescing to higher inflation than you could possibly want to have. Mm-hmm. And it makes it more realistic for them to be a little easier. If inflation is 2.8, it's not 80 basis points above target, it's in our range. And then they may feel more comfortable bringing the Fed funds rate down to 3. If inflation is 2.8 and Fed funds is 3, that's just a little touch more easy than neutral. If neutral is plus 50, according to R-Star and 11 white papers they published on that topic in 2018. So yeah, ultimately, the Fed will be forced to do what they always do now because it's the only thing to do because we're in the black hole, and that is to print more money, and that is the whole bullish story as to why the 40-year downtrend in interest rates and inflation, the 40-year uptrend in bond prices is over. And this is the bigger trend now because you're in that black hole and you have to keep printing to keep the economy going. Mm. Bullish for gold, of course, bearish for the dollar. And that's the whole theme. And that plays out from now through the end of next year, as far as I'm concerned.
Mm-hmm. Greg, what do you think this means for the inflation picture going forward? And, as I was thinking about this question, I think a good way to frame it is, from 2008 on, we saw massive QE and low rates. Yet it didn't really manifest in consumer goods prices, but yet asset price inflation went up significantly. So without the monetary stimulus that we saw after COVID, what do you see as the nuances of what drives inflation going forward and what sectors of the actual inflationary consequences are from here?
Well, you do have, kind of a double-sided dynamic here. I mean, there's crosswinds. So energy, if you look at energy, first of all, still negative on a year-over-year basis, right? And even when it's up on a month-to-month basis, it's still negative year-over-year. And that is set to continue through at least November. Because if you look at something like gasoline, we are still 50 to 70 cents below the previous year's price corresponding on the strip. So if you go out to June gasoline or July gasoline or every month going forward, you can see where the prices are. It certainly goes up during the summer, but it doesn't reach the levels that it actually attained last year. So you're still looking at significant degrees of base effect deflation, outright deflation in energy prices. And that has kept this most recent little upswing in inflation in check. If not for that, you still have a problem. The bigger question, of course, is, to me, food inflation, which is going to become much more difficult for a lot of the reasons that we've talked about off the air, which are the science of the planet and where food is grown and the things that are happening and how it's going to intensify. And it's not just dry, it's also dry, record flood, record heat, record cold. The whole polarization dynamic is at play in terms of food. So food supply, and then you throw in supply chain, you throw in all this, what we're doing with trade and becoming a little more tighter in terms of the, globalization dynamic, typically could hurt longer term dynamics in terms of erosion in some of the trade, shipping, logistics, all that kind of thing internationally, which could raise prices. Already the tariffs caused this huge need to build inventories before the tariffs took effect, which lifted warehousing and transportation costs in the US dramatically that are just now about to show up. So you have all these kind of factors too. For me, it comes down to service prices. Service is 71.8% of the economy, and last time I checked. And if you look at the service price X energy, which is only two components in services, you're looking at 79 components. 60% of them are above 3% year over year. I mean, that's a problem. So you look at rent, still 4%. And to whatever extent these things may, disinflate further, to get service price inflation back to 2% is a stretch because of a lot of the other things you're talking about in terms of margins. And then you talk about margins, potential businesses closing. Then you talk about less supplies of certain things. And all of a sudden, this thing becomes just a machine that keeps cutting itself down. And you see this in so many countries that have gone through what we're about to go through in terms of having to keep printing money to keep the economy going.
Mm-hmm. Well, of course, we know public debt is a huge piece of this puzzle. You mentioned private debt, but is there anywhere or any corner here that we're not like overly indebted? Housing, sovereigns, banks. Where is this saturation of debt basically present in every single market?
Pretty much. I mean, the one thing you might be able to say is that you do have one kind of untapped little gold mine in the U.S., and that's home equity. You do have a lot of home equity because the rise in prices and the HELOC, the home equity loans, have grown a little bit, but banks are a little reluctant, and there's, the dynamic around, credit conditions and all this. So if I were to pick out one positive, untapped potential resource that extends this kind of thing floats us a little longer, but that would tend to be more the people that have wealth, number one. And so, maybe in terms of, some homeowners that get in trouble might have some leeway. So maybe there's some extension of some housing problems down the road because of that, but that's not like necessarily a source or really an engine of consumption growth. No, the more realistic and more dominant factor would be the consumer, right? And when you're talking about a consumer who is, record high debt, even though it's come down a little bit in the last couple months, you don't want to see a credit crunch. I mean, that's the genie you don't want to let out of the bottle at this point, is a credit crunch and a consumer cocoon, and it's now out of the bottle. And when you talk about the consumer, and I can't stand these economists and stock market guys, and especially the bank CEOs and analysis that come on TV and tell us that the consumer is strong. I heard one guy even say the word robust, or the consumer is healthy, or the balance sheet is healthy. Nothing could be further from the truth. when you're talking about, all right, here's the black hole. Okay. Disposable personal income is now less than personal consumption expenditures. In other words, we're spending more than we earn now, and it's just crossed over like in 2022. All right. There's another one of these line charts that I have in my special. All right. The other way to look at it here too is credit card debt. All right. Let's take revolving credit, which is not all credit card debt, but mostly credit card debt, or commercial bank, which doesn't have a lot of. So that's 1.1 trillion, 1.35 trillion. Let's take the middle ground, 1.2 trillion. All right. Savings are 900 billion. Savings don't even make like 80% of credit card debt, let alone consumer credit doesn't include mortgages. That is now over 5 trillion for the first time ever. So yeah, it's saturated in the places that will do the most damage if you have contraction for the economy, the government and consumers. So yeah, I think it's, to me, and I never want to be too one-sided, because I'm always looking for things every morning. The thing I first do is look for things that refute what I believe is happening, or refute my positions, or refute my themes. All right. Why might I be wrong here? Okay. Now, it's especially true if we're losing money when I wake up in the morning, but that's pretty much every day, right? Is there something that's changed where I might want to take this opportunity to get out if we're making money, type of thing, right? Too. But it's hard for me to come up with any scenario here where we avoid this debt trap, because we're already in it. The time to make these decisions is past us. The biggest expense in the most recent budget numbers was Social Security. Second was interest payments. We can talk about that one, all day too. But, Social Security. And look, people that are under age 40 putting money into Social Security are going to get screwed. Everyone knows this. They're not going to get a dime, right? So let's deal with the problem realistically rather than politically. Because politically, the second you say we need to do away with Social Security, and this happened in Florida, I watched it, it's disgraceful, all right? The people should be ashamed of themselves that are out there promoting lies and fraudulent narratives just to get elected, okay? But you see it in Florida, where there was a Republican that was saying we need to do away with Social Security. The Democratic, and it's both parties. I'm neither party, okay? I'm a libertarian, so less government, the better. But when you talk about the Democrat then goes out and does this campaign ad on TV that was ad nauseum, all right? He wants to take away the senior citizens benefits, and you're going to lose your Social Security. You're 80 and you're living. It's like, no one has a plan to take away the 80-year-old Social Security. But this is what the guy's on TV saying. You vote for that dude, that's what he's going to do. All right. It's become such a political, hot potato. No one wants to hold it because you can't, because you're politically committing suicide. Look at Paul Ryan. He had the plan and he got run out of town. So that's the problem. And you talk about, can we change these things? No. Look, it's back to that thing I said before. I mean, debt ceiling. That's got to be the stupidest phrase that we use regularly ever outside of transitory inflation. There's no ceiling on the debt.
Yeah,
it's got to go up and up and up and up. There's no ceiling. We've crashed through every ceiling. You got to keep rebuilding this freaking goddamn, this office building because you keep breaking the freaking ceiling.
Yeah, as a concept, with a track record of literally zero adherence to it, there's no point to it.
Because it can't be, because it'd be too much more pain. The way we're going is less pain until it's not sustainable, and then it's the ultimate pain. So that's just one of those things. I'll give you an example, okay? So say you're a college student and you're not going to classes, all right? And you can't pass the final, okay? But it's now like, say, the end, it's Thanksgiving. Here we go. So it's Thanksgiving, you go home and you see your parents and you got to go back to school and you're going to, flunk out, right? So what do? Well, you keep partying because you're going to flunk out. You just wait for that day until you flunk out, then you're out. So that's kind of the path we're on to some degree. Maybe not the best analogy I've ever had, but, it does apply. Because we're headed there. It's inevitable. And when you look at the math, when you look at the charts, when you look at the history, it's obvious. It really is. This started, you go back to 1935, but really this started in 1971. When you look at the charts, you look at the bond market, when you look at gold, when you look at all of this in the context of the math that is underneath it, it's, to me, you almost can't debate it that it's not going to transpire that way.
It's something that I think kind of comes back to what I've dubbed the age of unaccountability, right?
Mhm.
We've come into this age of unaccountability where, we've been comfortable for so long. There's so many people that in a lot of ways run their government or their interests in government as a lifestyle business. We've had this luxury to not really care about it, and this is the place that it, cyclically ends up.
Well, look at the pushback you get from trying to save taxpayers' money from frivolous spending. I mean, the uproar on the other side of that is mind blowing that anyone could defend that and make this an issue they're going to run out and protest.
Mhm.
I mean, this is also the age of polarization, though, and it fits in with our political system, at least here in the U.S., where our strength was our two-party system, which is now our complete downfall because it's divided into two parties, right down the middle. So it's divided as it can be, and each end of the spectrum are more extreme. All these things that we've been talking about, even off the air, in terms of the bigger picture science. You see it more in anything in not only human behavior in public, but also really in politics.
Mhm.
Nowhere do you see the extremist views become more and more extremist without any sensibility whatsoever. And this comes back to one of these things that's an issue now in places like Sweden, and now it was in Denmark, or no, the Dutch were now. So it was the Dutch party that actually pulled out of the coalition because the coalition is not backing their new wannabe immigration standards where you can't just let anyone in the country, right? So this is everywhere. Sweden, there's a big movement now. There's one of the politicians that's really gaining popularity there that's spoken out very eloquently against, this whole movement into an ideology in the country of this Islamic, jihad type of mentality, right? So when you talk about, that kind of polarization and that kind of extremism and that kind of thing coming into the mainstream everywhere, again, it's like the sweet spot of the society is shrinking and shrinking, and the timeline is shortening. And I just, one of those other little things I like to say is, and it's hard to say given, that I'm a dinosaur these days, but I'm glad I'm not 20.
Mhm.
So, because that's 20 years from now, it's going to be I think it'll be a much rougher life, honestly.
Mm. Well, I mean, I think we're headed into an age, like, correct me if I'm wrong here, but we're headed into an age where there's more volatility and more extremes everywhere we look, not just in the markets, not just in politics, but everywhere we look.
Yeah, that's because it's the science. I mean, because it is the disconnect of human beings and the energy fields and the way the Earth has changed because of where the solar system is in the in the Milky Way. In the Orion Spur here, where we are is a highly electrified place. And it has a lot going on every side of us, which is the gravitational pull. We're getting hit with all this light, which is the electrified energy. The planet's vibrating at a higher resonance, and people are disconnected. And you see it everywhere. Not only that, but the animals are disconnected. Look at the animal behavior. There's things we've never seen before. And it's like, why is that? It's like because they're disconnected. There's a scientific reason for this. And the thing that is doomer and gloomer about it is that it's going to get worse. This is a several 100-year cycle of intensification of all these things. The disconnect, the resonance, the polarization, and the pure energy.
Mhm.
The good things are, what happens to the human brain during this process, sign of some of the spiritual enlightenment movement that might result from all of this. And maybe there's a place where we come to unity. But right now, that doesn't look like that's going to be the dominant trend. That's for sure.
Mhm. Well, Greg, I appreciate your time and, diving into all of these subjects. Of course, for those that want to hear or learn more from Greg, that's all available at Weldon Live on Twitter, also at money_podcast, and of course, weldononline.com. Greg, thanks so much
Yes.
for your time today. Really appreciate it.
Yeah, my pleasure. You guys do a great job. I'm always happy to contribute.
Thank you, sir. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.